Book and promise is that smart beta ETF really smart, or just smart at selling you a story. Welcome to the Capital Breakdown, where we cut through the noise and break down money markets and investing with clear, no-nonsense explanations. Today, we're diving into a topic that's both exciting and tricky: ETFs, or exchange-traded funds. More specifically, we're uncovering 5 red flags hiding in ETF marketing materials that can catch even savvy investors off guard. By the end of this episode, you'll understand how to spot when clever sales language might be masking risks or complexities, and how to approach these investment tools with the kind of due diligence that puts you in the driver's seat. Let's jump in. The problem or confusion: ETFs have grown wildly popular because they promise easy access to markets, diversification, and low costs. But here's the catch. Many people assume all ETFs are created equal, or that fancy terms on a prospectus automatically mean a better investment. Imagine you're shopping for a new phone and the salesperson keeps throwing around cutting-edge and revolutionary design. But when you look closer, the battery life is weak, or the screen cracks easily. With ETFs, marketing jargon like smart beta or active quant strategies can sound impressive, but it is easy to miss what's really inside the fund or how it might behave when markets get rough. This confusion leads to investors buying ETFs that don't fit their goals or risk tolerance, setting themselves up for surprises down the road. Well, core concept explained. So, what exactly is an ETF? Think of it as a basket holding different investments, stocks, bonds, or other assets that you can buy and sell on the stock market, just like a single stock. The smart beta label, for example, tries to suggest it's smarter than just tracking a broad market index because it uses certain rules or signals to pick and weight holdings. Picture a fruit basket. A traditional ETF is like grabbing a basket of apples, oranges, and bananas in fixed amounts, reflecting the whole market. A smart beta ETF might be like picking only the sweetest apples or the most colorful oranges based on a special recipe. The key is understanding that this recipe is designed by humans or algorithms with specific goals, and it's not guaranteed to outperform or behave like a simple market basket. Core concept explained. Continued. Another important term is index. Many ETFs track an index, which is simply a list of securities that represent a portion of the market. Traditional ETFs often track well-known indexes like the S&P 500, which covers 500 large companies across different sectors. Smart beta ETFs, however, may track specialized indexes that focus on certain factors, like value, momentum, or volatility. These factors attempt to capture patterns in returns, but remember, these patterns can be cyclical and may not hold up in all market environments. Ultimately, understanding the why behind an ETF strategy is crucial before jumping in. How it actually works behind the scenes: ETF providers are financial firms that create and manage these baskets of securities. They design the fund's rules, select the underlying index or strategy, and handle day-to-day operations. Investors buy shares of the ETF on the stock exchange through their brokers, which means the price can fluctuate throughout the trading day. Market makers and authorized participants help keep the ETF's price close to the value of its underlying assets by creating or redeeming shares. But here's where fees and frictions come in. ETFs charge expense ratios, which cover management costs, and some strategies, especially smart beta or actively managed funds, may have higher fees than broad market ETFs. These fees chip away at your returns over time, so it's important to compare them carefully alongside the fund's approach. How it actually works. Continued. Additionally, ETFs can have different levels of liquidity, meaning how easily you can buy or sell shares without impacting the price. Some niche or complex ETFs might not trade as frequently, leading to wider bid-ask spreads. Think of it as the difference between what buyers want to pay and sellers want to receive, which can add extra costs when entering or exiting a position. Regulators set rules to protect investors, but they don't guarantee performance or safety. That's why knowing the players and mechanics helps you understand both the benefits and the trade-offs involved. Simple, concrete examples. Let's look at two scenarios. First, imagine someone investing monthly into a broad index ETF that tracks a wide market like the S&P 500. This person benefits from dollar cost averaging, buying shares regardless of price, which smooths out volatility over time. The ETF holds hundreds of companies, so risk is spread out, and fees are generally low. The emotional experience might involve some ups and downs, but patience and consistency tend to reward long-term investors here. Contrast that with someone trading a smart beta ETF that focuses on a niche factor like momentum stocks. This fund might hold fewer, more volatile companies and could have higher fees. The price swings may be sharper, and if the strategy falls out of favor, losses can come quickly. This trader might feel tempted to jump in and out frequently, chasing performance, which often leads to frustration or missed opportunities. Both approaches have mechanics worth understanding before committing. Simple, concrete examples continued. In both cases, the key takeaway is knowing what you're getting into. Broad, diversified ETFs tend to be more stable and easier to hold over time, while specialized ETFs, though potentially rewarding, carry more risk and complexity. Emotional discipline and realistic expectations are your best allies, no matter which path you choose. Risks, traps, and common mistakes now. Let's talk about where things can go wrong. One major trap is assuming smart beta means less risk or guaranteed outperformance. These funds often concentrate on fewer stocks or sectors, leading to higher volatility and exposure to specific market cycles. Another risk is leverage. Some ETFs use borrowed money or derivatives to amplify returns, which can magnify losses just as quickly. If you're not clear on the fund's strategy or time horizon, you might panic and sell at a loss during downturns. Also, some investors overlook fees hidden in complex strategies, which quietly erode returns over years. Patience, diversification, and skepticism toward flashy marketing claims are your best defenses. Risks, traps, and common mistakes continued. A common mistake is chasing the latest hot ETF based on recent performance or catchy themes without understanding the underlying risks or how it fits into your overall plan. Remember, investing is a marathon, not a sprint. Volatility is normal, especially in specialized funds, and trying to time markets or chase trends often backfires. Understanding your own risk tolerance, investment goals, and time frame is critical before diving into any ETF. How to think about this tool. So how do ETFs fit into your broader financial life? Think of them as one tool in a well-stocked toolbox. Before investing, it's essential to have a solid foundation, like budgeting to cover daily expenses and an emergency fund for unexpected costs. ETFs can play a role in long-term goals such as retirement or wealth building, providing diversification and access to markets in a convenient way. But they shouldn't replace clear financial priorities or personalized planning. Use ETFs to help align your portfolio with your risk tolerance and timeline, and always consider how they complement other assets like bonds, cash, or real estate. Staying grounded in your objectives helps prevent chasing shiny new strategies that don't fit your plan. How to think about this tool continued. Also, remember that no investment strategy is foolproof. Markets change, and what worked well in the past might not in the future. Regularly reviewing your investments and staying informed empowers you to adapt and make smarter decisions. And when in doubt, talking with a qualified financial professional can provide clarity tailored to your unique situation. Recap and educational disclaimer. Alright, let's wrap up the capital breakdown on spotting red flags in ETF marketing. First, remember that fancy terms like smart beta are marketing stories that need a closer look behind the curtain. Second, understanding the fund's strategy, fees, risks, and liquidity is key to making informed choices. Third, patience and diversification remain your best allies to navigate market ups and downs. This episode is purely educational, not personalized financial advice. Always do your own research and consider consulting a qualified professional before making investment decisions. Thanks for tuning in, and here's to building your financial confidence one step at a time. Thanks for watching the Capital Breakdown. Remember, this is education, not personal investment advice.